coronavirus. This is the launch today of the Climate Bonds Hong Kong report. Just give us a couple minutes until people log in and we'll get started formally. If you look at the bottom of your screen, you'll see numbers continue to increase at the participants as people slowly but surely log into the event. Right, I think we might get going. Everyone, I'm Sean Kidney. I'm the CEO of the Climate Bonds Initiative. Today, this very day, is the launch of the Hong Kong Green and Sustainable Debt Market Briefing 2021. We're going to hear in a little while from our research manager for the China program, Manshu Deng, who will cover a few of the key points in a short presentation. And then we're going to have a panel with my very good friends, Lui Ying-Gan, Head of Sustainable Bonds and Debt Capital Markets for Asia Pacific, for HSBC. And I should say HSBC have been the supporter of our projects in China and in Hong Kong like this for many, many years. We have a long relationship. We also have with us the fantastic Tracy Wong-Harris, who's the Vice President and Deputy Secretary General of HK GFA, and has a role of Head of Sustainable Finance or Debt Capital Markets at Standard Chartered. And then finally, but nowhere near least, we have Kenneth Hu, who's the Head of Market Development Division of the Hong Kong Monetary Authority, and who I guess, Kenneth, we've been speaking to about green bonds, sustainable bonds, and so on with you now for, is it 7 years or 8 years? I don't know. It seems it's a lifetime anyway. And look how far we've come. Look how far we've come. Oh, I'm going to go some thoughts from Manshu in a minute. She will tell us how far we've come. But folks, you know why we're here. We do have a challenge. Unfortunately, despite the fact that we have been making progress on growing green finance, amazing progress, the global market for green, social, and sustainable bonds is now at US $3 trillion outstanding, which is, it was about 3 billion when I started in climate bonds many years ago. It's been an extraordinary fast-growing market. Is it fast enough? No. Have we done enough? No. Our challenge is that to meet our climate targets in particular, and our targets of developing a sustainable economy that will head off the challenges we face, we need to do more. In a report that McKinsey's put out in January, they said that we need to be seeing $9.2 trillion US, excuse me, using the US rather than Hong Kong figures, but the global figures are all US, starting now through to 2050 of investment each year in climate-related solutions. That's an extraordinary amount. That's mitigation, extraordinary amount, way, way above what we're currently investing. According to the Intergovernmental Panel on Climate Change, who released a major report early this year, we are still heading for the iceberg. We are the Titanic heading for the iceberg. And unless we reduce emissions 50% globally by 2030, and then get the net zero by 2050, we face an utterly catastrophic future. Yes, sea level rise on the shores of Central will be an issue. That will be an issue, but it'll be way, way more serious than sea level rise. It will be a tripling of the intensity of typhoons. It will be an extraordinary change in our global food production patterns, with the collapse of various food bowls around the world, like the Saigon Delta, which has unimaginable consequences for our ability to be able to feed ourselves. It will be more pandemics. The Intergovernmental Panel on Climate Change is predicting a century of pandemics for 30 years, because when we see drastic volatility in the climate, we also see the collapse of ecosystems, the movement of pathogens between species, which is what happened with the pandemic in the last 2 years, and disease. When we've experienced climate change before, in the 1600s in particular, the globe had a 2 degrees cooling because we'd killed off so many Americans and Merry India through smallpox and measles and spreading disease, essentially. 95% of all American Indians died. Civilizations collapsed. The forest regrowth was enormous. We suck so much carbon out, we cool the planet by 2 degrees. We, the rest of the world, experienced that as war, famine, and pandemic, not changing sea levels. And that's what we're looking at this century. We have an extraordinary rise in food prices, not to mention fossil fuel prices right now. A taste of the volatility of the 21st century. This particular rise is due to what is essentially a petrostate war. I won't go into the whys or whats, but just note that the war is largely funded by extra payments by Europe for fossil fuels since last autumn, since prices started going up. In fact, one of the protagonists in the war, Russia, has made more money from the extra revenues than it's cost in the war. It's not unrelated, folks. And this is the nature of volatility. You can't pin exactly what's going on. All you know, things are going crazy. And we're beginning to see craziness around the world. Just look at the temperature records for the last month in places like India, Europe, the US, extraordinary figures being achieved. So that's what we're looking at going forward. To be able to shift that, we need large slabs of capital going towards the kinds of investments that shift our society to becoming low carbon, clean and green, and resilient above all. That CapEx for resilience, preparing our societies for volatility, including sea level protection on the wharves, etc., will be about 50% more than the 9.2 trillion. You get a US that we have a year. You get a sense of the scale of capital required. We have proof that investors will invest if we create instruments that meet their needs, that both address their risk yield requirements and the longer term risks. And that's what the green, social, and sustainable bond market is. That's why this particular market is so critical. It's not necessarily an end game, but it proves that we can invest there. It proves something else really, really important, that investments in solutions are not negative, they're positive. These things perform in the international market. Oh, well, at least that's my assertion. We might hear a little bit more from our panel and from Manshu to see whether they agree in a minute. But there's no doubt that investors are recognizing these investments as lower risk because they now believe the shape of the future is certain. We will be clean and green, thanks to major announcements by Europe for 2030 cuts, by China with its 30-60 targets, and now by all the world's major economies that have committed to strong 2030 climate targets. All the investors believe this is going to happen now. They're simply trying to figure out who's going to survive the tsunami of change, policy change that's coming through the system. Green bonds, social bonds, sustainable bonds indicate organizations that are addressing these changes and are essentially lower risk, a better investment. Well, that's my assertion. Let's see if my friends agree. But first, let's go to Manshu Deng, who will present some of the key findings of the Hong Kong market report. Manshu, over to you.
Thank you, Sean, very much for the great introduction. Climate change is key. Green sustainability, resilience, that puts the context of what we do through systemic changes. So today, I'm going to walk you very briefly through the main points of this report, Hong Kong Green and Sustainable Debt Market Briefing. And this is the fourth iteration of the series of this report. It is sponsored by HSBC and supported by HKMA, Hong Kong Monetary Authority, and also Hong Kong HKGFA, Hong Kong Green Finance Association. And again, many thanks for the continuous support. The report really expanded its coverage to go beyond green. And we cover also green, social, sustainability, transition bonds, sustainability-linked debt instruments that include both SLLs and also SLBs. And together we call it GSS plus debt. And Hong Kong is truly a special place. It's got its own climate agenda, and also it serves as an international hub for green and sustainable financing to nearby regions and also countries. So here we provided two sets of data. And hopefully, together, they provide a holistic view of looking at the Hong Kong market. First of all, HKMA used the methodology of debt arranged in Hong Kong, looking at GSS plus label debt, including green, social, sustainability, transition, SLLs, and SLBs. And it divided the instruments into the universe by bonds and loans. Whereas Climate Bonds Initiative, we cover a worldwide debt market, green and sustainable debt market. We use the domicile of issuers methodology, looking at the GSS plus label debt market. We do not cover SLLs given its bilateral nature. And we divided the theme by green, social, sustainability, transition, SLBs. So let's look at the market in both ways. First, using HKMA's methodology of GSS plus debt arranged in Hong Kong, and we can see that in 2021, 57 billion US dollars were arranged, GSS debt were arranged in Hong Kong. And in the bond space, over 31 billion GSS bonds were arranged in Hong Kong. And that represented 1/3 of the Asian green and sustainable bond market. As you can see on the chart on the left, it's dominated by green theme, accounting for 72%. And then sustainability comes next. Private issuers formed the bulk of issuers. Corporate issuers accounted for 90%. And in this space, mainland entities continue to drive market growth with issuers of 25 billion. And that's about 80% of the GSS plus bond space. And also in the loan space, over 25 billion US dollars. That is green and sustainable loans were arranged in Hong Kong. And in terms of type of instruments, SLLs accounted for almost 2/3 of the market, indicating a wide adoption of this instrument as a general corporate purpose green financing tool. And also real estate, corporates borrowed the most, and most of them came from mainland issuers, mainland China. So overall, using the HKMA's methodology, we saw there's quadruple increase in GSS plus debt. And there is dominance of green theme in the GSS plus bond space. And in the loan space, SLL is really taking its pace and becoming the dominant theme in the loan space. So next, let's look at using the market using Climate Bonds Initiative, that is to use the domicile of issuers, look at the market in a different way. We also saw there's expansion into new types of thematic debt, and also expansion is across the board. Climate bonds identified 14 billion GSS plus label debt by Hong Kong issuers. And then there is quadruple increase, as you can see in this bar here, the orange one. That is, there is quadruple increase in green debt instrument. And here we mean the green debt that is aligned with climate bonds definition, which I'll talk about a bit more later. And also in the sustainability bond, we first identified in 2021 issuance from Hong Kong issuers. And then also in the SLB space, also transition bonds, there's burgeoning growth. We identified no social bonds from Hong Kong issuers, and we don't cover SLLs as mentioned before. And you may be wondering what GBDB is. Here, GBDB refers to the Climate Bonds Green Bond Database. As some of the old friends who are familiar with what Climate Bonds Initiative in terms of data coverage is that Climate Bonds screens label green debt across the different markets. We cover over 80 jurisdictions worldwide against the Green Bond Database methodology to identify those eligible for inclusion into our Green Bond Database. So inclusion into our Green Bond Database indicate general alignment to the the climate bond taxonomy. And also in other thematic bonds, we began expansion of data coverage in 2020. But the database is primarily for these other thematic bonds for tracking. We don't apply any eligibility screening on those yet. And this chart is taken from our China report, which was just published yesterday. That because we use the same methodology and the same procedure to screen labeled green bonds worldwide, we can also be confident to compare market to market. That we can see that the China had the most growth in terms of the volume of issuance in 2021. And the Hong Kong market is also one of the top growing market in 2021 by our definition. And also in the green theme, we also see the highest growth since 2016 in Hong Kong, both by volume and also by year-to-year percentage increase. And this green theme accounted for 3/4 of the GSS Plus universe that we cover. So this brings a cumulative of issuance of $20 billion, and with the issuance of 2021 being half of that. In terms of diversity, we saw a diversified supply led by the government and also corporates in Hong Kong. And the Hong Kong Stock government issued close to $6.5 billion of green bonds last year, spread across 6 deals throughout the year. That accounted for 60% of the total 2021 green offering from Hong Kong by climate bonds definition. And also what's encouraging is that 3/4 of those issuers are new. Either they are new by the definition that they first issued labeled green bond, or they first had the labeled green bond included into our database the first time. So some of those examples included Hong Kong Land, Kowloon Motor Bus, and also China Development Bank, the Hong Kong branch. And also, if you look at the chart on the right, in terms of user proceeds, we also see diversification. In 2018, you can see the user proceeds were mostly used for for low carbon building. But then that trend is changing, especially in 2021. And this is in part due to the wide range of UOP categories that the government covers. So government issuers really show the demonstrating effect here by including a wide range of UOP categories into its framework. And also it's very worth mentioning that the government added a new user proceeds category, climate change adaptation. Like Sean mentioned, adaptation is becoming very key, that it's being updated and included in this February, which allows funding for a wider variety of projects. And also in the report issued yesterday, we have statistics to show that Hong Kong Exchange remained the largest venue for China's offshore green bond listing, taking up nearly half of the offshore volume from mainland China. So for example, the municipality of Shenzhen issued its first green bond offshore, and that is lodged with the HKMA's Central Money Market Unit, a CMU, and listed on the Hong Kong Exchange. It was the first offshore green bond from a local government from mainland China, and also in the Guangdong area, leading way for further collaboration in the Greater Bay Area. So we also see that there's transition finance space. It's fast developing in Hong Kong. If really for transition finance, it facilitates investment in the economic activities that do not fit the scope of green finance, but they are essential for mobilizing capital flows that will enable the transition to Paris-aligned economy. Climate Bonds is one of the organizations that we published initial guidelines on transition finance. And this included using the 5 hallmarks here listed here to assess credible transition. In this report, we use the 5 hallmarks to assess a local case study, that is using the New World Development SOP. So we encourage using the 5 hallmarks to assess transition instruments, as well as a broader assessment of the integrity of a company transition. So please go refer to the report for the case study. So really, no matter we see from using HKMA's perspective or CBI's perspective, Hong Kong stands as an international hub for green and sustainable finance is strengthening. And we continue to see that, or also believe that that expansion will continue. And we have seen the Hong Kong's commitment in building a strong ecosystem to support the development in this space. And I will leave this here and for more panel discussion from our dear speakers. Thank you.
Thank you, Manchu. That was great. It's an amazing year, really. The growth of the Hong Kong market, the strength of the Hong Kong market is really cool to see. It's fantastic to see. I'm going to ask our panelists for some reflections, some thoughts about what's going on. I'm going to start, if I may, with Kenneth, because he's the regulator after all, represents the regulator. And Hong Kong Monetary Authority, of course, has been central to developing this market. Can you tell us a little bit more, Kenneth, about your view of what's happening and also what you're doing in this space to take this forward? Because I know you've got a lot of things underway.
Yep, sure. Thank you, Sean, and thanks, Manchu, for the excellent presentation. I think you both said it quite well, that the growth of the Hong Kong market over the past year has been pretty remarkable. No matter we used KMA methodology, which looked at the arranging location, or whether you use the CBI methodology, which focus on the domiciliation of the issuers. I think a few factors are driving this growth. Partly comes from a growing awareness among investor, amongst issuers about the need and the availability of green and sustainable finance as a viable channel for fundraising. The COP last year in Glasgow certainly helped, but also I think a lot has to do with factors such as the drive for sustainability, sustainable growth in mainland China. As many of you know, a lot of the financing activity in Hong Kong do come from mainland enterprises. And we see from the figures just now that about 80% of the bond arranged in Hong Kong come from mainland issuers. So a general kind of growing awareness and growing drive for sustainability, sustainable growth in mainland China also help with this. And obviously we also have a very benign macro environment, which we probably cannot count on this year again. So a confluence of factors were very favorable last year to the green and sustainable bond market. As to what we in Hong Kong are doing, we focus on 3 key areas. The first, obviously, as Sean mentioned, we are the regulator, so we focus on regulation. Disclosure, risk management are the key. And as many of you know, we have been making commitment to TCFD aligned disclosure by 2025. And with the introduction of ISSB requirement, we're also actively participating and hoping to take that up when the final standards come out. So that's one part. The second part is on infrastructure. What we're saying, what we mean here are things like talent, data, and also providing the right incentive for investors as well as companies to take on green financing. So say, for example, we launch a scheme to subsidize the issuance costs and the external review costs of green bonds. So that's one that has been eagerly taken up by a lot of issuers, which I can talk more in a while. And then finally, there's the awareness part. As we all know, to have green sustainable investment really going mainstream, we need not just banks and corporate support, but we also need the general public's participation. So earlier this year, for example, we did a retail green bond issuance with that in mind, hoping to raise the general public's awareness. So these are the kind of things that we've been doing, John.
The retail part was particularly exciting, I have to say, from my perspective, in terms of a whole new field sector opening up. But of course, the other areas too, like Manshu was saying, adaptation, also highly symbolic. Nguyen Gan, if I may go to you to comment on this, how important have there been these developments to get energy behind it? You're the head of Sustainable Bonds, Capital Markets Asia Pacific for HSBC, and full disclosure to everyone else, we have a very close and warm relationship with HSBC over many, many years, and they are the sponsor of this report, which is part of their commitment to supporting the whole sector and the growth of the market. But is this working for you on the client side? And what do you see as the impacts of this on deal flow coming through? Because Kenneth is hoping that we will see a further explosion of the market with the measures that he talks about. What's your outlook?
Thanks a lot, Sean, and then thanks Manshu and Ken for the interesting sharing. I think HSBC's partnership with CBI goes far beyond just sponsoring our report, which has been for many years, as you mentioned. I think we work together with you as an outstanding industry organization. We work with Standard Chartered as our outstanding fellow banks together to develop the market. And then last but not least, we work with our very supportive regulator like Ken and HKMA in order to bring all the momentum onto the stage. I think we are launching a 2021 report, but we are already past a half year of 2022. So yeah, I think 2022 has been a very challenging and very choppy market for capital markets and for debt capital market as well. So I think, Sean, you mentioned that I think at the end of 2021, I think everybody is expecting another booming year for sustainable bond in 2022. I would say that the 2022 sustainable bond issuance globally may be a little bit falling short of everybody's expectation, but this is not for no reason. It is exactly for the reason about the choppy market has been putting some of our issuer off the bond funding plan, but into other funding sources like loans. But however, in APAC alone, although that we see the G3 bond market issuance volume down by about 20%, we actually see the sustainable bond volume is actually holding up to a small single-digit increase. So you can see that on one hand is the bond market shrink by about 20% so far due to the unfavorable market condition, but we also see a single-digit increase from sustainable bonds. So you can see that sustainable bond has played an extremely important role in keeping capital market access to many of our issuers, especially under this challenging market situation. We also see that sustainable bond has been the first batch of product returning to the market when the market turbulence goes away slightly and when the stability comes back. So again, I think the support for investor as well as issuer is actually firmly supporting the continued growth of the sustainable bond market. But I think one important observation that I would like to highlight here is that in the past that we mainly talking about sustainable bond as a product, as a funding channel. So we would focus on the greenness of the project that we support. We focus on the COVID impact, the positive social impact of our social bond. But now I think increasingly investors are actually focusing on the overall ESG performance of the issuer. So by investing in a bond, they are not only caring about the framework quality, the SPO quality, but they are also caring about whether the issuer has a holistic strategy to support their sustainable development, not only by issuing a bond or taking our loan, but into much wider business strategy and operation. So as Ken mentioned, I think many of the regulators, they are developing further guidance on disclosure. The disclosure, many of them would focus on the E and the S and the G aspect as a whole as well. So some would be like the TCFD recommendation. Some of them would focus more on decarbonization disclosure, for example, for transition finance. But every angle of the ESG consideration would be greatly helpful to further enhance investors' understanding of the market, to increase their confidence about buying sustainable bonds. It's not only about buying a small portion of the business, but it's actually supporting the holistic development of the issuer. Yeah, I think that's my latest observation from the bond market. I will see Tracy maybe from the loan side. We also, I think from the CBI report, one very distinguished advantage is that we not only talk about bonds, right? We talk about loans as well. And we can see that from Manshu's data, not only green loan, but SLL as the latest come out on the loan market, it is also very dominating everybody's attention. And it is an extremely good product to increase issuers' awareness about how best to utilize their sustainability performance in order to keep and enhance the capital market assets. So I really want to recommend to the readers that the report is not only about bond, but also about loan. These products are supplements. And then we also want to see other products being added to the CBI report later on if possible in the future years.
Look, and absolutely, that's a very good point. Our ambition is to cover the overall growth of the market. A key challenge, by the way, to our listeners is getting hold of data, especially for sustainable-linked loans because of the bilateral nature of it. But that's working, and Kenneth might make some comments about that later, or at least I'll ask you about how regulators are thinking about that particular market. For all of you listeners, you can ask a question on the Q&A button at the bottom of the screen. We'll pick up a few in the next round. And this particular event is being broadcast live on YouTube right now and will be, more importantly, available as a recording afterwards. So in case you want to refer to your colleagues, Tracy Wong Harris, who's got a day job as Standard Chartered running the sustainable finance, but has got a night job, which is really the hat she's primarily wearing today. I'm assuming it's night anyway, Tracy, which is Vice President and Deputy Secretary General of the Hong Kong Green Finance Association. But also, you've had a very active role in growing Bay Area Green Finance Associations. Tell us more about that. Tell us more about it's going, and of course, about sustainability loans.
Sure. Thank you, Sean. And I like your description of 2021 sustainable finance market as an explosion. So absolutely spot on. And I really like Lorraine's diagnosis on the expectation of the GHS plus market for the 2020 expectation as well. I think that's very important. But one thing I think on going back to sustainability linked loan as a recent last few years development, it has the growth has been tremendous. So 2021 we've seen the global market 4 times globally, and in Asia 8 times. So 8 times of the growth. And I think part of the reason for the contribution of this growth is the opening up of from the traditional use of proceeds base to working capital, where like Liu Ying mentions on how investors are now looking at, instead of just on the use of proceeds into some green or social project. In addition, it's important to look at the company, the borrower's overall objective, sustainability ambitions as such. And I think the tool using sustainability link is a one great tool to articulate. It's a transparent tool to articulate these targets. And that's been one, opening from use of proceeds to working capital as a key drive. And also margin. Pricing is another key consideration. So with sustainability link loan product, the margins are tied to the performance of the borrower. And there are some regional nuances as well. So outside of Asia, typical are both sides. So if you hit the target, you get some incentive, pricing incentive. And if you miss, you get the penalty. However, in Asia, the market is still relatively nascent. And we have seen majority of the SLL is still one-sided. So incentive only. And that also attracts a lot of borrower to come into the market as well. So I think we will continue to see on this SLL sustainability linked loan market to grow in globally and the region in this and next years as well. So I think that is the key. And also I want to highlight the diversity as well. The diversification of the issuer segments are a lot more diverse, I would say, compared to use of proceeds base. And still very much led by financial. Financial is 20-something%, consumer about 13%, but then it's actually breakout from utility, consumer, technology, material, industry, really across, including energy as well, across. And in terms of jurisdictions, zoom into Asia, I see the greater China, so Hong Kong, China, Taiwan collectively is actually leading the market, followed by our peer center in Singapore. So this is the market that I expect that to continue to see growth. Now, switching gear from the a great product that I personally liked a lot to the GBA market. So as you know, Hong Kong GFA is part of the founding member of the Greater Bay Area Green Finance Alliance. So since the launch of the GBA GFA Alliance, there's a number of pilot projects already rolled out to the market, including greening the supply chain, blockchain solar, solid waste and solid waste management on the e-platform, and green building, etc. But last 12 months, the focus has been looking at how do we enhance the cross-regional focus. So instead of city driving particular projects and in the own city per se, but the enhancements of cross-regional working group has been set out for these projects to really enhance the adoptions and execution of these projects across city in the GBA area. And the new project that we have put up on is, I think Mansud also mentioned on the Common Ground Taxonomy. Given the significance of the Common Ground Taxonomy developed between the EU and China, and the latest updated report has come out, the GBA GFA has led actually Hong Kong Green Finance Association and the Guangdong Green Finance Committee has co-chairing a working group under the GBA GFA on driving the efforts in adoption of the Common Ground Taxonomy in terms of capacity building and also execution on transaction as well. So with that, we just literally issued the first phase of the report. It's a survey conducted across the market on opinion from across the ecosystem on the adoption of the Common Ground Taxonomy. So encourage the listener to this webinar to go check out this report as well on Common Ground Taxonomy. And we're expecting the second phase of the report to come out later on in the year as well. So here's the a few snapshot of the GBA GFA work in the GBA area. Back to you, Sean.
And full disclosure, Climate Bonds is working on the Common Ground Taxonomy with Dr. Marshall's team at Sigma University on behalf of the European Commission and the People's Bank of China. So just so everyone knows, just in case I say anything out of turn, we do hope to as Tracy Wong Harris, bring out a very substantial further development later this year. That's the plan, I should say. But it's a tortuous process, and this is one of the difficulties of the move towards clear definition and clarity. The Chinese market, and we saw the report yesterday of the report on the Chinese market that Lu Ying and Manshu were part of, has been built on a very clear green projects catalogue developed by or with the support of the regulators. And Europe adopted the same idea a little after China did, and now we have the EU taxonomy. This has gone global. Every country is doing it. But of course, there are differences in methodology. And I guess there's a question, Kenneth, to you about how you're going to manage, how you're thinking of managing this process at the moment. We have the Common Ground Taxonomy, where we have been very actively looking at exactly that, the common ground between the two taxonomies, the two guidances. But there are differences. In the building sector, for example, we have a real challenge identifying criteria, or rather labeling within the Chinese system that will be equivalent to the European system. So we're working on that, but it's hard work. Hong Kong MA, of course, has said in the past that it's planning to adopt the Common Ground Taxonomy, but we're kind of not ready. And I will say, I'm very sorry, everyone. It's taking time, taking much longer than we had hoped for various institutional reasons in Europe and China. Where are you going? What are you planning to do in Hong Kong?
Yeah, well, Sean, I can't agree more that it's hard work, it's a torturous process. I think we all want to adopt some kind of common ground taxonomy. Partly is for maintaining interoperability, comparability, so that issuers or investors, they don't have to go around doing multiple external review and comparing multiple standards. For Hong Kong, it's particularly important because we've always prided ourselves as the connector between mainland China and the rest of the world. And this common ground taxonomy is exactly the common ground between mainland China and EU, which is globally a leader in this area. But I think we also have to be realistic about what the common ground taxonomy is about. It's not exactly a taxonomy as such, and it's also not kind of standard as such. And there are areas such as industry classification or other kind of jurisdiction specific factors, do no significant harm in Europe, for example, that's the kind of context that each of the jurisdictions taxonomy operates. So it's very difficult to just take the common ground taxonomy and then say, okay, well, this is the Hong Kong taxonomy. Instead, it's more a kind of handbook, a reference tool for us to develop our own taxonomy. And that's exactly what we're trying to do. We will be building a framework on the basis of the common ground taxonomy, and then we'll be taking the structure out, our idea out later on this year or early next year to consult the market. So we still hope to build something from the common ground taxonomy, and we'll be using whatever we can from that document.
And with the question on the Q&A box, with the explosion of the sustainability loan market that Lu-Ying and Tracy were talking about earlier, do you see a need for differential regulation or tighter regulation in that particular market, or do you think things are going reasonably well so far? What's your current reading? And look, I know you can't make any formal announcements. I'm just curious about your comfort level.
Yeah, I think the proliferation of different types of product is positive in general. I also see another related question in the Q&A box about greenwashing, how we want to make sure that basically issuer are not just sticking a green label on top to capture the additional investor attention or interest rate differential. And I think part of it lies with product design, by looking at the performance, the ESG performance of issuers holistically, rather than just the use of proceeds. We could potentially enhance the overall governance of green and sustainable bond. Part of it lies with things like taxonomy, like disclosure. I think, say, for example, the EU's sustainable finance disclosure requirement, the framework is a good thing. And given the reach of UCITS funds, for example, it could potentially help set the global best practice. So all these kind of work together to ensure that the market is growing in a sustainable and healthy way. Right now in Hong Kong, our securities regulator, they have their own set of rules surrounding the disclosure, for example, of funds, and the HKMA, obviously, I mentioned earlier about TCFD, about ISSB. So all these should help contribute towards more transparency and better governance.
Fantastic. Lu-Ying, you mentioned earlier we've had a pretty bad first half of the year, Q1, Q2, so far have been low. But in previous years, Q3 and Q4 have been really strong. As a rule, the market does trend up in the last quarter. We had been thinking that we might still see a pretty substantial growth in the last quarter, particularly as Q1 and Q2 are dominated by the volatility in Europe with war and food prices and so on. And if that settles down, of course, there's a big if around that, then we might see changes. Plus, we're seeing the growth of some new developments around climate policy globally, and then, of course, markets like SSL. I'm teasing out your level of positiveness about this or not, because you're on the front line of this. You're actually getting people coming in the door and asking about practical deals, and so you've got a sense of the potential deal flow going forward. Can I be optimistic in saying we're going to see a big bounce up in Q3 or Q4? Am I mad? What's your reading?
This is a very good question, Sean. I think we always say that bankers do not have a crystal ball, but we do hope that we always hope that the market will come back sooner rather than later. So hopefully, I think due to the subdued activity level in the early 2022, once we see the macro environment becoming more stable, hopefully in Q3, Q4, we do hope to welcome back many of our issuer clients. In terms of green and sustainable bond area, to bring a green and sustainable bond into the market, we do need to do quite a lot of work. For example, helping them to select the project, setting up KPI, working on the framework, getting on SPO, etc. So I think we are trying to funnel those work into the quieter months in 2022. So we are actually building up quite a healthy pipeline of issuers who are waiting to hit on the market when the market conditions return. So hopefully, I think Q2, Q3, we would be able to see not only more issuance in terms of volume, but also in terms of diversity. So diversity can come from different products, like maybe more SLB from APAC, which we have seen the development level is actually below Europe and the US. We hope to see a more diversified area of issuer coming to the market. So not only banks, not only public sector organizations like the US, I think Asia Pacific are actually offering quite a good variety of projects that are on the table for investors to pick from. And last but not least, we really want to see some of the high impact issuer coming to the market. So we always hear investors would like their money to work harder. So by buying an APAC green and sustainable bond, they hope to use the same amount of money, but benefiting a larger amount of people and making a huge and bigger social impact. But I think when we talk about international investor and then buying good impact APAC, and many of them, like Manshu mentioned, actually originating from Hong Kong. One very key concern from them is exactly what Sean mentioned. So there are a large amount of international taxonomy in the development. Singapore is developing its own, and ASEAN has already got their standards. And Hong Kong and China and the Common Ground Taxonomy, they are all developing. But do we see really investor and issuer find that overwhelming, or do they find them useful? I think we need to see them in two layers. So certain degree of standardization is always good in the capital markets. In the green bond market, it has been developing for more than 10 years, and then ICMA Green Bond Principle, which has got the updated version earlier this in 2020, in June 2020. I think it is a very well adopted standard already. And then all the EU taxonomy, common ground taxonomy are actually offering an additional help in issuer to tightly define their green project and focus, and also for investor to exactly pick the area and geography and sector that they would like to invest in. However, because different countries would be at different socioeconomic development stage, I think I see this really clearly from APAC. Before I moved to Hong Kong, I worked in London, also in green bond. So I have to say that when I was in London, I think the issuers are more homogeneous. But in APAC, we are seeing a very diversified degree of development, both in terms of ESG, in terms of economic status, and as well as in terms of impact mandate as well. So we do need to allow those issuers to come to the market with a credible story. We cannot use a one-size-fits-all approach to get all the green development, especially in the local market. Then this topic would become more seriously when you look at the transition finance. Maybe not green, but they actually have a much bigger role to play in helping us to achieve net zero 2015 and in alignment with the Paris Agreement. I think there is very heated debate on how to define transition finance, how to define the border between transition and green. And I always think that every country, their will should be heard. They should be allowed to tell their story in a credible way, instead of only being asked to meet, for example, the EU taxonomy, or for example, the other taxonomy that which may not fit their socioeconomic conditions nicely. However, this is easier said than done, right? So I think with the help of climate bond initiatives, I think in Manshu's slide, I think you mentioned very good 5 steps of how you CBI define transition finance, right? So this is a very strong and good standard for us to follow, that CBI saying that this is what you need to do. If you cannot do that, please explain your rationale behind that. So we look forward to working more with CBI, with Canon, HKM regulator, and with our peers in the market in order to drive the further development to benefit a wider issuer in order to keep or enhance their capital market assets.
And I would have to say to our listeners, you'd start thinking about competition issues at a point like this, but the extraordinary thing about this market is the level of cooperation, that there is an amazing amount of work amongst institutions, shared work amongst institutions about how to grow to this market on the basis there is a broader social good that we're contributing towards through this, and there's room for everyone to support each other. This is a bit of a phenomena. I mean, I'm going to say this doesn't really happen in competition or around securitizations or whatever in quite the same kind of way, or at least from an outsider, it doesn't look like it. But you raise some
We now have a
points
sustainable securitization as well, Sean,
Oh.
as per the new ICMA. So hopefully we are spreading the good things around. Yeah.
Because it's sustainable securitization. Absolutely right. And so this green sustainable market is binding us in ways that we haven't been bound as much in the past. The transition point's a good point. For our listeners, we need to understand what are credible. I think Tracy and Luyan used the word before, credible transitions, which is what do we need to do? If Toyota was to build a hybrid plant, a new hybrid plant in Guangzhou for cars, is that good or is that not? That reduces emissions by perhaps 15 or 20% compared to other cars they've been building in the past. But is that enough? In the IEA's transition pathways, they're saying it's not enough. In fact, because if Toyota builds a hybrid plant, it uses petrol as well, that knocks out the opportunity to build a new electric vehicle plant, which it means that it cuts out the chance of steeper emissions reductions and improvements. So understanding what are the necessary ambitions we need to achieve our external targets, to transition to external targets, is a critical pathway issue out of this. Now, luckily, Toyota is in fact now building electric vehicle plants, so not an issue, everyone. But you get the idea of why we need this guidance and why it's important in the steel sector and the chemical sector and in the aviation sector, for example, to understand the right kind of forward guidance, which is credible in terms of the targets we're going to achieve. And that's the discussion that's happening in taxonomies around the world. In ASEAN, for example, the ASEAN Taxonomy Board, made up of central banks, has published some material around this in the COP in Glasgow and more work coming through. And in every market we're working in anyway, it's a big part of the issue. But the credible transition and the confidence around the environmental contribution of the investments is important. Tracy, in the sustainability loan market, this is especially an issue because we're looking at KPIs, key performance indicators of various sorts that people need to achieve. But at the moment, we don't really have external guidance about how ambitious those indicators need to be for different entities. So it's very much a bilateral trusted relationship. Is this an issue with this market? Do we need to see stronger guidance, or is the development of the credibility of the market very strong as it is? Give me a bit of a sense of your reading.
Sure. So I think SLL is not just like, I don't see it as a bilateral, because we have many syndication loan on SLL in the market, which we do a lot. And we, I think, take a step back. On the SLL principle, this year alone, it's been upgraded 3-4 times. And with the enhancement of all the, for the audience sake, for all the SPT data, every year, the borrower need to say, these are the data that we're saying we achieve or not achieve the target. And those are required to be externally verified. So those data that's submitted to us before we look at the margin adjustment, those need to be externally verified. And very much like a bond deal, on a syndication, when the syndication go out to the market, or even bilateral, we engage a lot of the time. We engage the second party opinion, and Kenneth will know, because we also apply for the Hong Kong Green and Sustainable Grant Scheme for these SLL structure as well, so that actually there are safeguard and the requirement for going out. In the past we look at bond and loans, the robustness and differences, but actually sustainability link, I argue that with the recent upgraded standard on ambitiousness, the second party opinion will look at what is the global global market or industry is doing in those particular KPI, and what is that industry is doing, and what is that particular borrower is doing in historically, to really make a comment on whether that particular selection of KPI is material enough for that borrower or for that industry, and whether those targets are ambitions enough. And you get it's the same as a bond deal, that you get comments and rated on whether your ambition limited, or not at all, not relevant. So I think this is actually a lot more required in the SLL market, and this is continue strengthening as well as all the standard has been, moving along with the market that continue to improve. So that is my gut feeling, and I, as like both sides, from investor or from lenders point of view, I actually like to see those particular target being laid out transparently, and tiling the margin to it, to have the borrower responsible to actually demonstrate back with an external verification view. I actually think that is a much more transparent rate than use of proceed, where the impact report is not also compulsory in the yearly impact reports, also not compulsory, right? So I think the markets are growing, of course, but I think there's a lot more kind of safeguard around it, and the principle has been really fastly improving to really prevent to be perceived in the greenwashing space.
There you go. We need to wrap up. I just realised, my goodness, we're nearly at the hour. I've got before we go into last comments, Kenneth, interest rates. We're seeing an increased interest rate environment globally. Is this going to impact negatively, positively? Are you willing to take any comments? Look, this is very tough to ask a regulator, right? So I'm giving it a shot. Do you see an impact?
Yeah, I mean, we in addition to being a regulator, we also are the agent for the Hong Kong government's green bond issuance. So we are also paying close attention to what's going on, how the interest rate is going. And kind of talking from an issuer's perspective, I think it's tough. We're kicking ourselves for not doing more last year, and that, but it is what it is. And I think overall, the rising interest rates is going to have an impact. But hopefully, as Lu Ying said earlier, the growing take-up of green and sustainability bond is going to offset some of the negative impact. So net, we're hopeful and keeping our fingers crossed.
In very liquid markets, US dollars and EUR, we see a clear price differential becoming the norm now between green and vanilla, largely on the basis of secondary market performance. So people tend to hold on to or treat their green bonds, and to a lesser extent, but still importantly, the social and sustainable bonds, as a premium product. And what that means is, when there's a downturn of the market, these bonds hold their value. They become value retention products. And of course, fixed income investors are primarily defensive. So they're interested in making sure they don't lose money in this process, which is driving price performance. So we're seeing a differential. The German green Bund, for example, got a 2 basis points benefit on its issuance price. A negative interest rate bond too. My pitch is that as spreads widen, so will the differential become more visible in different ways. Now, for an issuer, that means more advantage. But of course, for an investor, that also means more visibility to the premium in the bond. And what we're seeing in the primary market is a split between the benefits, the secondary, and then some benefits given to the primary market. So I'm actually hopeful, Kenneth. I'm actually thinking this is going to boost the green bond market. But hey, it's a volatile time, everyone. We will see how it goes. And I think that's the key point about the world we're in. Volatility is becoming the norm, as predicted by climate scientists, as reflected in our economy. And expect more of it, more kinds of turbulence, which, goodness knows, we've seen a lot of the last couple of years. But look, last comments. If I can start with you, Tracy, and then go to Kenneth, and then to Lu Ying. Give us your thoughts on the outlook and the benefit. And I do know there's one question in the market I had in the conversation that we hadn't picked up, which was the benefits of this market. How is this translating through to real benefits on the ground? We might pick up in our final remarks, but just give me your last reflection, Tracy Harris.
Sure. So I would say, despite the strong growth we've seen in the sustainable debt market in 2021, and very much congratulations to Hong Kong for quadrupling it, and with a great support from the Hong Kong government. But let's not lose sight the huge funding gaps we make, right? We still have that over 100 trillion funding gap to fill in order to arrive to net zero. So I'll say from organizations, policymakers, and even down to consumer, we must take urgent actions to accelerate to zero. And collaboration across agencies, both public and private sector, to further advance the product innovations, including establishment of high integrity voluntary carbon market, would be the key. So with that, I would say, let's get back to work.
Beautifully said. Kenneth.
Yeah, I would say this is probably a year for of coming of age of the whole green and sustainable financing and investment market. Last year was very good. Volume was up. General awareness was up. But I think there were some difficult questions that were not being answered. How the market will perform as interest rate goes up, market condition tightens, and also some difficult question about greenwashing and the case surrounding green and sustainability investment. I think these questions have to be addressed properly if we were to grow the market further, and I think this year is a good time to answer it.
Manchu, you've been suspiciously silent. Before I go to Lu Ying, any final comments from you?
I really enjoy the community, the discussion here. Like you said, it requires all stakeholders to grow this market. So glad to be part of it.
Lu Ying,
Yeah,
we've been together for so long in this project. Sorry,
yeah, maybe let me wrap up by answering. I think there is a question about raising interest rate and how the sustainable bond market has been performing in our Q&A panel. I think so far, raising interest rate has increased interest funding rate burden to issuer. Like Ken just mentioned, as he's also one of the issuers as well. So we are seeing that in this challenging market with a raising interest rate, issuer would try to tap all pocket of money possible in order to complete their funding plan. And sustainable finance would be one very important channel to increase the investor diversification, to attract investor to look at your transaction. Maybe the investor would not be able to look at otherwise. For example, they would have green bond fund to buy you. They would be able to maybe increase the tickets. So I hope that with all the bankers go back to work, like Tracy mentioned, and then we work harder, we will be able to offer more help in helping our issuer to keep and enhance their funding channel in a challenging market, as well as to amplify their sustainable development goals and sustainability strategy in order for a better future. The better future can be a decarbonization focus, like our climate bond, the climate focus, or more sustainable and social. And yeah, I think that's a holistic story that we would work on together.
And that's a good point about the purpose of this market. Signaling is a key part of it. We're trying to let issuers, let investors know that we're doing something to stay ahead of the wave of risk that's coming across us as our world transforms, as climate goals, as sustainability goals start getting addressed and implemented. It's also important to understand that bonds are primarily a refinancing instrument. They're not a project financing. For that, you're going to get a direct loan, maybe a sustainability loan, or you're going to equity lending. By growing a large market in this area, we ensure the refinancing, the easy and successful refinancing of project development, which provides greater churn at the project level stage. So when you're looking at the benefit of the bond, you need to understand in the context of the capital stack, the different roles, different forms of capital instruments. One thing we've done, though, I think you'd have to agree, is we've absolutely established a sense of opportunity around the concept of green and sustainable and social investment. This is a change in the last 10 years. People used to say, this is going to cost us. I'd love to do it, but it's going to cost me more. We now say, people are saying, this is actually an opportunity for us, an opportunity to signal to market, an opportunity instrument, an opportunity for investors to ensure their portfolios not only meet short-term returns, but also address long-term risk. And that's the real value and benefit of this market. But of course, it is only just the foundation. We have started. We have nowhere near finished. We have to get to much higher volumes to be able to be confident that we're making a difference, the real difference. And of course, we need to see the actions by corporations, by governments, by all sorts of entities to further meet our challenges, to bring in policies, to bring in new business lines and so on, that are future fit, not stuck in the 20th century. But that's all the challenge ahead of us. One thing's for sure, the trend is upwards. It is volatile. Quarter one, quarter two, as Louis said, was tough for many reasons. But the trend over the last 10 years and going forward, I think everyone would agree, is very much growth. Growth in green, growth in social, growth in transition, growth in sustainability linked loans, growth, thanks to the HKMA, in adaptation going forward. There's a lot to be done, but we're making progress. Thank you so much, Kenneth. Thank you so much, Tracy. And thank you so much, Louis Ying and Manchu, for being with us today. Thanks everyone for listening. We have a lot to do. It's up to all of us. Good luck.
Thank you.
Thank you.